All right, I think we're live. It's just me today. I reached out to Chris to see if he could join, but I couldn't reach him. Maybe we'll catch up with Chris later in the weekend and see how his Friday went. Let's see here. So this is March 6th, 2021. It's Saturday, and pretty wild end of the week. So lots to cover here. First up, I want to talk about this company, FIZZ, which was up huge on a down day. And so this was standing out on my watch list. So I took a position in it. And normally I'd be into a mimosa or a coffee right now. But instead, I'm doing some market research. And this is a LaCroix sparkling water, which is one of the products of this company, FIZZ. And so I'm going to be enjoying that while we do this trading homework. So yeah, you can see right here, LaCroix is one of their products. Let me get the chart up and we can start looking at the chart. Oh boy, there it goes. Well, that was funny. It's all over my keyboard. Good thing that was just water and not beer. Or mimosa, that would have been bad. Alright, let me get the chart up here. FIZZ. It smells good already. This flavor is Pamabaya cranberry apple. So yeah, it's looks like it's breaking out from some real tight closes and holding at support around the $50 price level. It doesn't mean that it's going to run. This chart looks similar to another one, Sava, where it had a huge pop and then it fell back and consolidated. And it had some kind of like false starts that looked just like this. I'll be right back because I'm going to get a paper towel and suck up all this fizzy water. So sorry if you're watching live. I'll be right back. All right. So I want to look at Sava too, because that's another one that's been on my radar. And so maybe this is like a good sign that I spilled this water. And here's why. Because it spilled onto, maybe this is like an omen. It spilled onto my copy of this book, Options as a Strategic Investment. So for people who don't have that book, I really recommend getting it. It's a fantastic book. This is the options it's the options position trader's Bible. And what I do is position trading. I'm not a day trader, and I'm not really a swing trader either. I do position trading. So almost done. And we'll see if this ruins that book. I doubt it. I didn't spill that much. It's just water anyways. All right, it's cold now. I'm going to taste it. Yeah, that's fine. It tastes good. All right, anyway. Where are we? So we talked about FIZZ. If you had already seen my trading homework from, I think it was March 3rd was the last time I had one out. I talked about a short position in Tesla and also in ARKK. And what I had done was I had put on some iron condor trades in ARKK, and those trades make money if ARKK has normal behavior, if it stays kind of in a tight range. However, it didn't. So ARKK started really breaking down, and I used the credits from the iron condors to buy deep out of the money puts on ARK, and also bear put spreads on Tesla. And so I lost some money on the iron condors. I actually closed those out early because when there's still a couple days of time left till expiration, I closed them on Thursday because it looked like it was just going to tumble into a free fall, which it really kind of did. The technical damage to ARK and the ARK portfolio holdings is so great now that, you know, I think it's probably going to catch a bounce. But like if we zoom in on this, you know, it could bounce back up to some of these moving averages, but these are not healthy charts anymore. And with this volume coming in like this, there's a lot of reason to be skeptical of the rallies here. You know, to think that this is going to go back to business as usual in Tesla, you know, that's not really what I'm expecting. So I'm expecting more of this kind of, you know, quick drops followed by some consolidations. You know, just little rallies that get people interested in again. And it was a furious bounce off the lows here. So anyway, let me talk about the Tesla trade also. So this, let's zoom way in on Tesla. This was a home run trade for me. And this paid for way more than the little losses I had on the iron condors. So all the way up here, I think, was it, what day is this? March 2nd? Yeah, I already had the trade on March 2nd. So I talk about 1-inch punch trades on this show where there's 1 or 2 days left until expiration. This was more like a 6-inch punch trade where there was like 4, 5, 6 days till expiration. And you could still get huge force from a big move. What I had put on was the 650, 600 bear put spread. And when Tesla was, it was right here as it was breaking down, I think, is where I put the trade on. It kind of like made this run up here like a false breakout and then got stuck underneath these lines. And so just kind of going from memory, I think it was when it was in the range between, it was around $700 is where I put the trade on, between 720 and 700, probably closer to 700. And so I ended up buying the bear put spread for, I think it was at a price around $3 is where I was getting in. So let's take a look at that. I want to do like a deep dive on this trade because there's more to it than just, you know, that I put on this spread. There was a lot more to it than that. You know, we can't actually look at last week's options. Unfortunately, they expired, but we can look at a similar one. So let me build like a similar one if we were looking at this going forward. So it looks like this. I'm in the strategy builder, buying a 650 put and selling a 600 put together as a combo. This trade is not going to resemble, I mean, this is fully in the money. What I have was like 100 points lower. So let's look at one that's like 100 points lower. So going into next week, it would be kind of like buying a 550, 500, except look at the price on this. It's higher. It's like $7.71. So I got one that was like even cheaper. It was around $3. And the most a 50 point spread can be worth is 50 points. So, or $50. So let's try and find the $3 one for next week, just to kind of talk through this for illustration purposes. Probably be about like this. So yeah, this one's like, so per combo, if you were to buy this, assuming that it opens near Friday's close prices, it would be $362 per combo plus commissions. And so this is what the spread looked like when I got it. So it's because Tesla has fallen a lot and it's gotten more volatile. It takes a much bigger move to it takes more points. So this is more points out of the money than the one that I got. So I'm gonna take this sleeve off my book here so it can all dry better. Yeah, the book is actually dry. It's just that sleeve is a little wet. Well, this is like an interesting feature of the water here. It's like evaporating completely without leaving a residue on my stuff. So, awesome job, LaCroix. Yeah, it tastes really refreshing. All right. So this is what it looks like, the profit potential here per combo. It's this is around 11 or 12 return to risk. It potentially could be made on the trade. And Tesla actually closed. So the one I had was the 650, 600.
Market data connection lost.
And what I did is on Thursday, when that spread went into the money, it actually went fully into the money and then bounced back halfway. And so what I ended up doing Thursday, I think it was either at lunchtime or near the end of the day. I don't remember which. But on Thursday, what I ended up doing was rolling down and strikes. So I closed out the 650, 600 and rolled it into a 630, 580, which is even more aggressive. But what that does is it does a few things. I essentially locked in profits with about a 4-to-1 return to risk locked in. And it leaves the trade riding. It leaves a lot of money riding on the trade, but for a further move, an even more aggressive move down. And I was right to do it because Tesla went so much lower even. And what happened is when it went all the way down here to 540, there's still like hours left on the trade. And so the highest I saw the ask on the one I had at that time, the 630, 580, was it was worth around 47 for the ask, and the highest the bid got was like maybe 46 bid, 48 ask. I think was about as high as it got. And I thought, you know what, that's like kind of close enough to taking all of the money as a profit. And so when it bounced back like this, I put in a close the trade order at midpoint and just kind of sat on it for a minute, and it filled at 45.5. So I actually made more than what I could have originally made on the trade because I had already pocketed a whole bunch, and then I made 45 points. That wasn't all profit, but I sold it for 45 points out of a total potential of 50 for the second go around. So I actually made more than what it looked like I could possibly make at the start of the trade. And ironically, it was using a defensive move to do it by kind of locking in profits by rolling down on Thursday. So that's something I'll do when these trades work really well and there's still a lot of time left. I'll roll in the favor of the trade when they're working. Hang on, let me just mute my audio here. I don't know why this is being so noisy. I'll just turn it way down. So yeah, this was a really fun position to have. The other big thing I did that I want to talk through, I felt really smart about doing this, is I've been talking really bullish about an emerging trend in the silver miner space. So let's talk through that because I did a super move yesterday. So I don't like this sudden weakness in silver here. I'm not exactly sure what factor is driving it down. But I became suspicious when I saw this chart here, the GDXJ, which, you know, it looked weaker than it should. It should be holding up better, and loop. It really should looping higher right here in early or like mid-February. It should have been hooking higher, and instead it's now hooking lower. So this is like a negative sign if you're like me and you're accumulating long-term out-of-the-money calls on miners. Well, I don't really want to dump them, so there's a few things I'm doing. Let's look at SIL, because most of the holdings I'm accumulating are in SIL, like Wheaton Precious Metals, First Majestic Silver, Pan American Silver. These are holdings in SIL. So if you wanted to just use SIL as a proxy and just concentrate position in SIL as a substitute for going into all those miners, that's something you could do. But the reason I'm going specifically into the individual miners is because if silver has a big problem, it could turn into a problem for brokerage houses themselves. And so I don't want to I don't want to have another intermediary between me and the shares if silver has like a ridiculous move higher. So that's why I'm not in doing these trades with SIL, because normally I might if the liquidity is better than the miners, and it may or may not be. It's not something I've looked into. So the biggest holding that I have is this one, First Majestic. And what I had been doing is during this period, so I started getting in like through this whole, after this big gap up, I started accumulating these out of the money calls. And while the trend was higher, after I had established an initial position, I'm adding contracts on down days. However, when it got below its 21-day EMA, that's when I changed tactics. And so, while it's trapped under moving averages, if I still want the position, which I do, what I'm doing now is I'm actually rolling down in strikes instead of adding more contracts. And what that does is it does a whole lot of things. One is for the price of one contract, you can actually instead move many contracts down several strikes. And so instead of adding contracts, I'm rolling down. Let's take a look at what that looks like. So over here, let's go to AG. And the contract that I'm buying is this one. It's on this calendar, the January of 2022. And what I had been buying was this 35 strike. And what I ended up doing was instead of buying more 35s, I rolled all the way down to the 27. And so I put in an order at midpoint, and I didn't even really have to change it much. I mean, I think my orders were feeling pretty good. I mean, you just keep raising the bid on your order until all of it's filled. And I didn't have to raise it that much, so it was pretty liquid. I was glad to see that. So to give an idea what that looks like is I would click on the position and use the roll tool that IB has. And when you roll, it shows you a calendar, and it shows you an open leg. In this case, it's this one, the 35, and it shows you that you're going to be selling the 35. And it prompts you, pick the strike you want to roll into. And you could pick a different calendar if you want, and you can pick any strike that you want. And so in this case, I kept the calendar the same, and I rolled from the 35 to the 27. So here's what it looks like. It looks like I'm gonna have sales proceeds at $1.79, and that it's gonna cost me $2.25. That's if you have to cross the bid-ask spread. However, I told you that a lot of my fills were happening near the midpoint and maybe slightly above it. And so what the order presents as in IB is it just shows you the debit to your account that you have to pay in order to take on that new position. or if the one you're closing out is worth more than the one you're going into, then in that case it shows you the amount of the credit, and that's really what the bid is. And so if we figure out what the midpoint is, just eyeballing this, it's probably around I don't know, like 190. We'll say 192 for the midpoint here, and the midpoint on the 27 would be 245, I guess. And so if you think about like the price of that debit is about the difference between those. So 245 minus, we'll say 190 is 55 cents, I think. And so it would be a 55 cents debit for me. And so 55 cents debit would be, I could get 4 more contracts, or I could roll, I'm sorry, I could get 1 more contract, or I could roll 4 contracts down in strikes. And another advantage to rolling down in situations like this is what I'm thinking about too is that 55 cents. Well, how much faster is that going to evaporate at this higher strike if the silver miners stay in this lower price range? It looks like they're rolling down into a lower price range. And so if you have options that are further out of the money, like the time decay on the 35 contract is going to be a lot higher than the time decay on the 27. And so, like, yeah, it's a debit of 55 cents or whatever. But, because this 35 is a lot further away now than it was for a lot of my purchases, this is going to burn up time decay faster than the 27. And, I'm planning to spend a lot of time in it. I may have to roll it out to April at some point. Maybe this April or May, I'll roll out to April. Maybe as late as June, I might roll out to April. It really just depends. So this is all situational stuff. This isn't like I've got some simple guideline I'm following, like set your stop loss 10% below your entry or something. Like this is not that kind of trading. This is position trading. There's nothing wrong with that other kind of style, by the way. It's just that, what I do is position trading. So anyway, so we talked about some of the advantages of rolling to lower strikes. And I did this on a lot of things. So Southwestern Airlines is something that I have been accumulating. We can look at that one. And so I rolled this one to lower strikes as well. Just going from memory here, I think what I had. Let's see if we can reconstruct this. I think what I had was at the January 2022 calendar. I believe what I had been buying was the 85s. And I think what I rolled down to was the 75s. And again, like, it looks like I could roll down for each new contract I could add at 85, I could actually roll 2 or 3 contracts down to the 75. And again, like, I'm also saving on time decay by doing this. And what it also does is when, if this stuff bounces back, which it already did bounce back pretty heavy. I was doing a lot of these rolls at lunch, and that's when intraday it was like at these lows. So it's already kind of bounced back a lot. But the thing I like about Southwest Airlines right now is that it's pretty close to its 52-week high. And like that's what I'm looking for in things right now. When I say that the ARK portfolio, like there's just so much technical damage on all those charts, they're really far from their 52-week highs, a lot of that stuff. And I want to look through that and see, like, are some of those holdings in a recoverable looking state, like Love is just 1 or 2 up days away from a new 52-week high. So that makes me feel comfortable. The miners, not so much. Like they were really close to 52-week highs, and now like pretty quickly they're not. So I'm rolling these down aggressively, and I'm going to continue to do that. If this moves into a lower range, there's a few things that I'm planning to do. Is the weakest area of the miners is either GDX or probably GDXJ. And we can actually see that exactly by doing this, a ratio chart. We can do ratio charts on these, and you can see that in March, because this is going down and GDXJ is in the numerator, GDXJ has been weaker than GDX. Let's actually zoom in on the time frame. Look at 30-minute bars. And it's quite pronounced, that weakness. Let's look at it now against SIL. So GDXJ is even weaker than SIL, exactly as I suspected. And so what I will do, if I think that there is a lower price range going to be established, like down here around 40 to 35 here, it's going to drag the silver miners down too. Like, this is not a healthy looking chart right now. It was healthy looking in February, and now it's not so healthy looking. So what I'll do is, if I still want to keep building that miners position, out of the money long-term silver miners, then if I expected the price range to drop, then what I'm going to do is put on fairly short-dated put spreads in GDXJ. And then if I have profits there, then I'll take those profits and use it towards the credits on rolling down in strikes on the out-of-the-money silver miners that are long-dated. So this is something that I'll do is you can even look at SLV, and SLV might even be the best place to do it. So yeah, GLD, wow, I mean, that is looking really weak on the daily chart. So maybe GLD might be the place to do it. So I'm looking at essentially using short dated contracts as a hedge, and what I'll do with the profits of those hedges is roll down in strikes on out of the money long dated stuff. And the idea is I'm trying to keep those strikes close enough so that they will come into the money, and hopefully with about 6 months till expiration. So that's the goal there. Let's actually compare GLD to GDX. And okay, so it's pretty similar movement there. That's a little surprising. I guess I'm surprised at how tight that range is. So GDX is pretty volatile. And GDXJ is even more volatile. I think it was, there's a guy on Twitter that I follow pretty closely. I'm going to bring up some of his tweets from earlier today, and he's talking about the relationship between the juniors and the major silver gold miners. Let me bring up his Twitter. Okay, here we go. All right. So, I mean, the way he's doing analysis on this kind of stuff is super advanced. So, it's he's bang on with some of this analysis. Let me see if I can find it. CCJ. Let's stay focused and find what we came in here for. I mean, I could read all his tweets. I mean, they're fantastic. Here we go. Semis versus gold. So this is a related tweet. Yeah, he's doing some of the similar ratios like we're doing, gold miners to gold right now. Like, I mean, if you're an investor in the precious metal space, like this kind of, you learn to do this kind of analysis, and it's super helpful, not just on gold and gold miners, but everywhere. And so semiconductors to gold. This is super important. I was showing on I think it was the March 3rd trading homework with Chris. Chris was on with me, and we were talking about the QQQ to silver ratio chart. And I mean, it's so trendy. And so a lot of us are watching for when is this major long-term trends, when is this going to turn? So for a long time, it was really favorable for precious metals. And then in 2011, there was a major turn, and it started to move for the NASDAQ and the tech stocks, it move in their favor. But these are long-term trends that it can turn around and go the other way. You can see the .com bust right here, what that looks like, and I mean it's in the late 90s. If you were on the other side of it, if you were in the metals and not in tech, you were missing out big time. But then it was the opposite. Like, you just didn't want to be in tech at all, and being in the metals was awesome. So really great chart. So here we go into the ratios here. So gold miners to gold ratio. And he's using actually the gold spot price. And so that's why the scale we're seeing is different, but the shape should be similar to some of the ratios that we were looking at. The hourly is bouncing, but the weekly matters the most. So this is the weekly, I think, right? I don't see where it says the scale. All I can see is the calendar at the bottom. Oh, here it is. 60-minute. This is the hourly. Okay. So the hourly is bouncing, and not much. So this is what we were talking about. GDXJ to GDX. In times of volatility, you must zoom out to larger time frames. Yeah, and Brian Shannon wrote a book about that, technical analysis on multiple time frames. I have that book. It's pretty interesting, and it's a beautiful book too. Yeah. All right. So that's somewhere he was talking about comparing the. Let's see here. I think that he had some comments about the juniors, that you want to see them outrunning the majors in any bull sector, including, he was talking about with banks. I wish I could find that tweet. Anyway, you guys can find it. I mean, he's got a lot of fantastic stuff here. All right, so talk through my plans there with the metals and with Southwest, and another one I did this on was Carnival. So Carnival's still looking good to me. It's near these the breakout from this range. It's still like very close to that breakout, and I did a similar thing where I rolled down in strikes on my long dated stuff. Okay, so let's look at the ARK portfolio real quick. ARKK. I'm over on Yahoo Finance, and I'm going to go over to the holdings. And I just want to quickly just look at these charts. So Tesla, Roku, Tdoc. And, this may be stale. I think ARK probably publishes on their website the holdings, or at least the change in their holdings. So, these exact percentages, I'm sure, are stale. I don't think Yahoo gets updated every day. So Tesla, I mean, look, it's not going to be back at new 52-week highs anytime soon. And so, if you're trying to be like a distressed buyer, or you want to buy these crashes, or buy the fear, like, you could do that. But I like to buy things coming out of bases, especially like in new emerging trends. So probably what I'll be doing is shorting bounces on this. I don't have a position for next week. The options are super expensive right now in the short term. I like to let the implied volatility come back out of it before getting in there. What I did do though with the ARK puts I had is I actually rolled them out. Some of them were in the money yesterday, especially intraday. And so I rolled those out to next week, and I already had some small position established for next week. Something I may do is for every 2 contracts I have that's out of the money, what I may do is sell those and buy 1 contract that's closer to in the money. Let's talk about that real quick, and then we'll continue looking through these charts. Do I have ARK up here? I do. Okay. So next week, I have like all kinds of strikes on this one on the puts. I think 105 is probably the closest strike I have. So I've got strikes all the way down to 80. And let's look at the chart for this real quick. Charts, new chart. So you could see that. I mean, yesterday this thing spiked up huge, and so and then it came back down. I just sat through it at this strike. Like I wasn't making any moves with that. What I was doing was I was making moves with stuff that was expiring Friday, and so a lot of what I rolled into was I basically rolled all the stuff I had that was. I basically sold everything off, all of those ARK puts on Friday, and rolled them into this strike right here, the 105. And I mean, similar thing here, like huge spike, and so it's worth like a little fraction of what it was at one point. However, I think probably early next week. I don't know that it's going to be a huge bounce or even a huge drop necessarily. I think probably we'll see a little bit of volatility come out of things. And that already started to happen. Like VXX dropped a ton. This guy Quarry Rock, he called it and he traded it perfectly. That the after the European close, that the VIX would deflate, and it did. So great trade for him. I'll show his Twitter real quick. Well, here let's talk about this idea though real quick before I flip away. So I don't know why these contracts aren't showing up, but an example would be like selling off 2 contracts at one for close to midpoint, but maybe 140, and then simultaneously buying for every 2 sold, buy 1 contract for the twice the price. So in this case, $2.40. So we'd have $4.80 for every 2 we sold to buy 1. So what we could do is we could sell 2. I'm sorry, I'm looking at the wrong one. Why am I talking to the 110? Well, let's say hypothetically it was the 110, because I'm missing a bunch of strike price data here. But if it was the 110 I was selling, for every 2 I sold at $2.40, I'd have $4.80 I could use to go buy on the other side. And so, and you want to try and execute this close to the midpoint, but what that can let you do is convert from the 110 strike to the 116 strike. And you could do this with whatever ratios you need. So you could sell off 4 of these 110s, and that would give you almost $10. So you could roll up from the 110 all the way up to the 125. You just have to sell off 4 of these. For every 4 of these you sold, you could buy 1 of these. And so doing those kind of like ratio conversions is a really helpful tactic. It's helpful to have that in mind. It can allow you to move across strikes. And a reason why you might want to do this, I mean, I don't know that I would want to get into the 125, but if the 110, if the 105 and the 110 sort of like start falling apart, I may want to try to preserve the time decay by getting closer to at the money. All right, let's look through those ARK charts. So we looked at Tesla, and it's so far from its 52-week high that I would need to see on a short-term chart like a really constructive looking base after a long consolidation period before I'd probably be a buyer of Tesla right now. I mean, the volatility is going up. You don't know if this is the beginning of a tech bust or not. And so with volume coming in big like this, and it's just up so much for so long, there's all kinds of hype. If you look at all the things, sort of the cottage industry around Tesla is huge. And so, these things dilute each other, or they kind of take investment demand from each other, and it can become too competitive. Not enough dollars in to support this just like massive valuations on these things. So, all right, let's keep going before we look at more electric vehicle stuff. Let's keep going through the ARK portfolio. Roku. Yeah, again, like it's over 100 points away. It's underneath these moving averages. It's actually like underneath every major moving average right now. And it's the same with Tesla. Like if I bring Tesla back up here, let me make these charts bigger. It might make it easier for people to see. I usually try to have them bigger. All right, maybe once more. Why not? Okay. So hopefully it's easier now to read these numbers. But the point is, like Tesla's price at 597 is underneath all these moving averages. Now these are all as resistance now. So if it bounces, probably it could easily stall out at all kinds of these levels. There are a lot of people in this stock at higher prices that when they get back to break even, they're going to look to get out. And so that creates a lot of resistance. So we looked at Tesla, we looked at Roku, and really what I'm looking at is this price level underneath a whole bunch of these key moving averages. I mean, it can hug this lower Bollinger Band for a long time and just kind of like just keep going down. I mean, it's oversold right now. Look at the RSI; it's underneath 30, but it can stay under there for a long time. Like look at it on the opposite, on the upside, it stays above the 70 for a long time, and it hugs the upper Bollinger Band for a long time. Like it's there's no reason why it can't just keep hugging this lower Bollinger Band. And this is a range expansion period. It's a bullish wick on this candle, but I mean, it's just one data point. So, all right. So next up, Tdoc, and then we'll look at Square. Tdoc. Yeah. So back at the bottom of this range here. So this one actually may be in better shape than some of the other ones that are kind of in air pockets to the downside. So there may be some support here around the 180 level, and then again at the 170 level. Because there's a range here. But this is a less bullish chart overall, as far as like, it just, yeah, it's up, but, it's not up like Tesla's up. And I'll prove that. Let's look at the ratio chart. Tdoc : Tesla. Yeah, I mean, it's just not even really a competition. However, like the idea of Tdoc or the Teladoc theme, like it's a great fundamental, especially during COVID. All right, next up I said was Square, SQ. Was that down like 25% or something? Yeah, this one looks more bullish to me than Tesla by a lot, because it's still in a situation where it's generally making higher highs and higher lows. So, I think Square actually looks kind of bullish, and it may be that there's some kind of like crypto side of the story here, but I mean, I don't know. Tesla also has that, because they went out and bought Bitcoins, and they're claiming that you can transact in Bitcoins or buy your car with Bitcoins or something. I mean, I don't know. I don't follow it as closely maybe as I should. CRISPR, CRSP. Pretty big volume, but yeah, and it's down pretty hard. However, it kind of reminds me of the what was it, the Roku chart, or no, maybe it was the Tdoc chart. Yeah, I think it was the Tdoc chart where it kind of had like a support zone here. So if you drew a line, kind of maybe a horizontal line around this, what was resistance that became support, like we're there. It bounced off of that on Friday. A friend of mine suggested that I watch a documentary on Netflix about CRISPR and this technology. I have not watched it yet, but he said it's fascinating. And maybe it's scary too. I don't know. And also, this thing has been oversold for a while. So that's, underneath the RSI on the daily for a while. Let's look at the weekly. Is it also oversold on the weekly? No, not yet. Let's look at that with Tesla. That would be a good thing to know. So Tesla is not oversold on the weekly. In fact, like, if you look at previous major sell-offs in this thing, it's really just had this one in 2020, the March top, where it fell, what was this, over 50%. I see a peak of 193 and a low of within a short time, like just a few months later, a couple months later, it went down as low as 70. Bounced off a major line. So if this line really is the support, this 50-week moving average, simple moving average, it's at 420 right now, but by the time it gets there, it'll be higher. But I mean, that could be like a target if you're a Tesla bear or you're shorting Tesla, or if you're a long-term Tesla investor, maybe that's where you might look to buy, is at the support of that line. Because I mean, it just, to me, I don't see a whole lot of support. Probably around 500 is where it'll have support, and that's not that much lower, I guess. It did kind of bounce from. Let's see what level it bounced from. The low on Friday is 539. So it didn't get there. It didn't get that low. And so I think my take after this drop right here, this drop from like a week or two ago, my take there was that it would drift up to the 21-day EMA and then roll over. And it was even more bearish than that. And I called it out on a later trading homework that, it didn't even pull that off. And so that was another reason why I went kind of aggressive on the Tesla put spreads. But now I want to let some volatility come out of it. I don't have a Tesla position. All right, we have a few more ARK holdings to go over. We went through half of them. Invatia Corp. I don't know if this is a biotech. I don't even know anything about this one. Let's learn about Invatia. Ticker symbol NVTA. Going into the profile. Let's see. Medical genetics company. So DNA processing, sampling, and stuff. Okay, so kind of like a CRISPR. NVTA. This chart looks uglier than CRISPR to me. It's so far from those highs. Previous highs in late 2020, over $60 a share, and it's now just a little over half of that. So, I mean, this thing is on a major downtrend right now. It's been outperforming CRISPR just slightly in 2021, but doesn't really look good. Okay, next up is Proto Labs, Prlb. This sounds like a biotech. Let's find out. Prlb. Profile. Proto Labs, together with subsidiaries, operates an e-commerce driven digital manufacturer of custom prototypes, on-demand production parts in the worldwide Wow. Okay. Injection molding, computer numerical control machining, 3D printing. Okay, so it's a 3D printing company. Proto Labs. Cool. Okay, PRLB. PRLB. So one of the ETFs that ARK operates is PRNT, and that is a 3D printing company. So this must be one of the bigger holdings there that fits into the broader innovation theme that is ARKK. It's down pretty heavily off of its highs. I mean, you know, again, the technical damage on these charts, a lot of these companies are in 50% drawdowns or higher. I don't know if I can put a drawdown study on here. Let me check because I'd like to have that. No, I don't know why they don't have that. Like a drawdown. Maybe they do. I'll look into it. Okay. I'll have to look into that later if we can get a drawdown chart on there. And something else is the ATR. It's just like really high. So let's look at the ETF for 3D printing. First as a ratio chart. So PRLB colon PRNT. So Proto Labs is underperforming the 3D printing ETF. PRNT. I mean, that's in a pretty big drawdown. And it just looks like it had this blow off top, and now it's kind of the move is over. And you know what's interesting too to me about this is the people that are doing this selling, probably a lot of them are trying to front run people who are holding out for long-term capital gains. So, you know, that can just show you that holding out for long-term capital gains, not necessarily always a good idea. Like if you bought this at the market bottom in March, you'd be much better selling it in February probably than selling it in March or April, even after factoring in tax consequences. What you could do is if you didn't have a whole lot of time left until you reached long-term capital gain status, you could buy puts or a put spread that gets you to the long-term capital gain status. So if you go far enough out on the calendar, like what you can do with the put is you can put stock to the put seller. So if you buy the put, then they have an obligation to buy from you the shares at the strike price of the put. And so if you had, let's say that back in February, if you had to get all the way to March before you sold, but you're worried about the price doing what it's doing, plummeting, what you could have done was like bought some 45 puts with, I don't know, a month or a little over a month of expiration on them. And then what that would let you do is you'd essentially be locking in these gains, because profits from the put would essentially or multiple puts, whatever, you'd have to like have the right amount of puts, but the profits from the puts on this drop would essentially negate a lot of the losses that you would have had on your shares. And so that could be a way to essentially carry that position through a drop like this if you were really close to that finish line. So that's something good to know for if you ever find yourself in that situation, you're carrying shares. I don't know if institutions do that kind of thing or not. All right, a few more ARK holdings to go through. Baidu. Okay, so this is a Chinese company. Baidu. Yeah, it's down a lot also. I mean, this is... So really, the best looking one is Square out of all the holdings so far. let's just click through the other ones. Zillow and Spotify. I bet Zillow and Spotify are holding up maybe okay. Yeah, Zillow looks pretty good. I'd put that maybe in second place after Square of as far as like of the holdings that look kind of healthy. It's still down a lot, and this is like it could be maybe a blow off top here. When you look at that big volume right here on this gap up, I guess, and it just ran out of gas. It didn't really go very far. That was probably an earnings announcement gap up, although I'm not sure. So I mean, it's fallen hard from that gap up, and on a percentage basis, I mean, it's a deep drawdown. Also, the RSI is not. I mean, look at this sell-off. You know, look what the RSI did. This is extreme, though. This is the lockdown crash. If we're looking at like another tech bust on this kind of stuff, you can expect the RSIs to look like that. I mean, it could get brutal on this stuff. All right, one more. Spotify. Yeah, that's a healthier. On a relative basis, this chart looks kind of healthy, but Square looks the best. So interesting. We could maybe conceive of a pairs trade where we're long Square and short ARK. You can see that it's been outperforming. It underperformed in January, and that's it. For all of the rise since the March lockdown lows in 2020. So I don't know that I would even bother with that as a pairs trade, but you know, if you wanted to try and pick out the weakest one, you could do that, or maybe like, you know, let's look at the ratio chart for Tesla, Square to Tesla. Yeah, so I mean, Square has been really strong, and it still looks pretty strong. How does that stack up against PayPal, which interestingly is a former Elon Musk company? So Square even is outperforming PayPal, although not that much in 2021. Interesting. All right, next up, let's look at volatility. So we want to take a market view. My market view, one thing I did is when all the volatility came out of stuff, like VXX went down a lot at the end of the day. If we zoom in on this, I mean, minus 7% on Friday, which you just would not expect that for a big down day like that. So VXX has not been a great hedge. I think people buying this have been disappointed, and really for a lot of the spikes. Like even this one here in January was like kind of a disappointing spike. Like it got started, but then it fizzled out and went on to make new lows. And so there are some reasons for this, and we can get into that. But let's zoom in and look at a 10-minute chart. So it went from being overbought on a 10-minute RSI on Thursday, and it tried to make it there again on Friday and failed. And I think that's when this guy Quarry Rock took a look at this and put on a monster trade. So let's take a look at that for a second. A lot of people may not know that this guy's out here on Twitter. This guy right here, Quarry Rock. So he's got this padlock on his account, so you can't and he's got it set where you can't even retweet his stuff. If you could, I'd be retweeting this guy all the time. If you can find him and follow him, I'd recommend doing that. I like a lot of his content. Let's see here. Let's find his calls on VXX. We have to keep going back. Here we go. So 1550 puts plus 1,000%. So, I mean, he's just calling it all day long on his VXX puts that he got. And I think these were Friday expiration. I mean, look at this. So he called it out. If you were watching it, This is an amazing trade. Let's see. I don't. Okay, now we're on March 4th. I don't know if he called his entry on it or not, or maybe he posted that somewhere else, or maybe he didn't post it. I don't know. Let's see here. Come on, VIX, show us you care. So that was 23 hours ago. This is probably when he put that trade on. What's the time on this? Can we see the exact time? If I click into the tweet, maybe. Yeah, okay. So I'm in Central Time Zone. So this is right about when the European market closes. Looks like he put this trade on right before the European market closed. At it's 11:30 Eastern Time and 10:30 Central Time, which I think nails the bottom. So let's look at this. Let's look at VXX, and I want to look at an intraday chart. Okay, so let's zoom in a little more. 5 minutes. So he may have put that trade on right around here, and it went a little higher. If that's when he put the trade on, it did spike a little higher. You know, I may be wrong. It could be that European market closes at 11:30 Central Time and 12:30 Eastern Time. I need to look that up. That's something that I need to know, because if that marked the exact peak in VIX for the day, which it has before, I know that for sure. If it did do that again, like that's just such a valuable thing to know. And so, I mean, what was his puts that he got? I'm assuming he got the ones that were expiring that day. 1550 put. 1550. And unfortunately, I can't bring up the chart for that put if it's the one expiring Friday. But what a great call. If he got that for real cheap. So anyway, at the end of the day, after all this volatility came out of VXX, I went in there and just did a little bit of nibbling on SPY puts. Let's look at that one. The one expiring Monday is I tried to keep it at the money. I had to keep rolling it. So I got the 382 put, and then I rolled to the 383, and then I rolled to the 384, and then finally it looked like it started to roll over a little bit. So I kind of got burned. Had to roll a few strikes, but you know, if it does go into the money pretty hard on Monday, then it'll more than make up for it. And the other reason I got it is because of this. Like, you know, VXX came down so much that by the end of the day, it was dirt cheap to get these puts. So if you look at like, here's how cheap these puts are. Where did SPY close at? We need to know the exact close price on SPY, not where it went in after hours, which is what this is. So let's go to Yahoo Finance. Let's go to SPY. Looks like at close it was 383.63. So a 383 put is actually cheaper than a 384 call. So there's not really any smile to this volatility. Like, that's how much volatility came out. And so because it got so cheap, I decided to get some I wanted it at the money, because if I didn't roll it, okay, from, you know, to keep it at the money, then the problem with that is through the weekend, if the price doesn't move anywhere, These ones that are out of the money are going to get blown away with time decay, but the ones that are at the money are not going to get hit as hard. So that was my thinking there on that. Plus, like, I don't know what's going to happen on Monday as far as, like, direction for SPY. Let's take a look at that. So one of the big drivers was, if you see the RSI on the 10-minute, when I put this on, it started hitting over 70. I mean, it was just this huge rip straight up. And a lot of times these will correct. I don't even need it to correct very far. But, if it moves, just even a few points or corrects halfway through this move from 372 to 384, it may not, though. Looking out, it's a really bullish looking candle on SPY. And so a lot of things people are talking about is like, well, why is SPY holding up so well? Why is VXX not spiking up when we see all this volatility? Well, the volatility is mostly concentrated in tech. So if we go to QQQ, you can see the drawdown in tech is pretty big. It's like it maybe touched around 10% drawdown. Maybe slightly bigger than that. And the volume coming in is big. And ARK is even worse. And we've already talked about the technical damage on a lot of the ARK holdings is severe. Like, these are broken stock charts now. And I mean, this to me, when you see the stock keep on making wicks like this at the bottom, and it's not slowing it down, and it's not, like, it's still making lower closes. Like, that's what you see right before you see, like, a bar that just looks like this, just straight down, like, closing all the way at the bottom, and that's the extreme blow off panic out. That's kind of what I expect to happen. So when I talked about rolling my puts on ARK to next week, it's because I'm still not seeing capitulation either here or in SPY. And so I don't know if next week is going to be like a dead cat bounce back up to some of these moving averages and set the stage for the big plunge. But it doesn't have to do that. I mean, it could just keep on like skidding lower. Like these wicks here are dip buyers and people that are trying to like get a deal and catch the bottom. These are your knife catchers. And I don't know that it's going to work out so well for them. Like, it's putting on the brakes so far hasn't really worked. So anyway, back to SPY though. Like, what's holding SPY up is look at XLF. Okay, it's at new 52-week highs. And this is something that I've been talking about on this show is XLF and XLE. So XLF, the driver for that is the wide yield curve, and XLE, this is running higher because the reopening. We're seeing states that are ditching their mask mandates. We're seeing, I think California just said that theme parks and things like that can reopen in April. So, the sort of full reopening and travel ban stuff getting repealed, and the vaccine is a safety blanket for a lot of people. Like, they're going to feel comfortable going out again, and so that's the driver for XLE. And the way that I'm playing that is I did a 10,000 foot view overview of the market. I think that was probably 2 weeks ago now on a weekend trading homework, or it might have been like a Thursday night or something. I went through all of the, I made a list of all the ETFs. I'll show you how to make such a list. That were not leveraged ETFs. I skipped over those. If we go to, I already have a FinViz window. Okay, here we go. So what you can do here is, let me clear out these filters. Let's actually just go away from the screener and go back. Okay, now it's reset. And what you can do is you can say industry. And if you go down here, I think there's, exchange traded fund right there. And then what I did is I sorted them by volume. And I went through this list, and this one, SQQQ, this is one of these leveraged ETFs. So I skipped it. This one, also a leveraged ETF, skip. And so I just made a list of all the ones I found. These are not leveraged ETFs. VXX is not a leveraged ETF, although it is like a derivative thing. XLE, IWM, HYG. I just made a list of these in a spreadsheet or a notepad or something. And I put up another window and went down the charts. And when I got to Jets, I looked at this and I saw this sort of like really kind of a big cup and handle. And I thought, okay, this is great. Like, I want to get in on a new emerging trend in Jets. So they hadn't really participated a whole lot in the recovery other than this like initial pop in May. So each one of these corresponds with like a reopening kind of event. This was the vaccine news was happening around the election time. This was when the original harsh lockdowns, like international travel lockdowns, loosened, I think. So every time we get some news like that, this thing makes a big move, but it hasn't been sustained yet, like what a lot of things that we've seen. And so, like casinos, for example, if we look at Penn, like why is the Penn chart look so great compared to Jets? Well, I mean, I don't have a good explanation for that, other than maybe they're participating in esports betting or something. I don't know, but this actually looks like it's kind of rolling over here. It's breaking down through this support level, which is now turning into a resistance, and also these Bollinger Bands are really narrow. You know, if the Bollinger Bands expand and it hugs the lower Bollinger Band, you can see a waterfall decline in Penn. I'm not saying it's going to do that, but I mean, you know, that's got my attention. It could be a scenario that plays out here. So, I mean, Penn has surprised me to the upside. I lost money shorting this last year. Or buying puts on it rather than shorting it. So anyway, going through those ETFs, I was excited about Jets at the time. I made a lot of money also on the MJ move. So this was looking hot, and I got in on this. Although, I didn't have a big position on it. It must have been like early February when I did that analysis. So because I did it right before this blow off, and then I mean these are now at support again. I may start going back into these. I got out of every marijuana stock holding I had after this major drop when it looked like it was not going to continue higher without building another base. And now it looks like maybe, it's got some support here. It's still, it's the uptrend still looks intact to me. And I don't trust the Biden administration or Biden-Harris administration, whatever, to follow through with their campaign promises about marijuana decriminalization. I mean, I just don't trust them at all. But nevertheless, this may be a good spot to start to get back into MJ stuff. So what I'm doing is I'll probably use two. I'll probably use AFA, which looks great actually, and Tilray, TLRY, and these are the two I'll go into probably. And the way I'll do it, probably I'll do this on Monday morning, as long as they don't explode higher. So I think enough time has passed for a lot of the implied volatility to come down on those stocks. So let's look at Tilray and AFA, and I'm gonna show some option combos that I'll be looking at on Monday. I don't know exactly what I'll get, but let's talk through some swoosh positions in those. Because once the trend is underway, that's how I like to play it. And these are already in motion in an uptrend. Okay, so let's start with AFA. APHA. So what I'd be looking to do, and by the way, like the implied volatility, it's a lot lower than the historical. So that kind of confirms what I'm saying. So it may be a good time to get back into them again. So I'm going to be looking at a calendar of about 3 to 6 months, maybe a little more. So I'm going to look at October. And I want to construct a combination where I'm buying 3 to 6 months out at the money call. So AFA is at $16 right now. So we're going to put a $16 October contract in the combo. And then what we're looking to do is to buy protection on this that's short dated and slightly out of the money, like 10% out of the money. And the idea here is we want to pay about a third, somewhere between 25 and 35% of the price of this is what I expect to pay for protection. So that's a reason why I need the implied volatility to drop enough in order to put one of these combos on. Is because if implied volatility is too high, then I'll have to overpay for the protection, and also there could be a lot of time decay on the at the money option if the implied volatility is too high going in. So let's see here. I would expect this to be about $1.50 or $2 for the protection, and I want to keep it between 2 and 4 weeks. So I'm going to start with 3 weeks out, which would be March 26th. So that's about 20 days away. And 10% lower under 16 is 14.5. So yeah, there it is at $1.50. So if you build enough of these, you can kind of guess what it'll look like. So this is $6.08 per combo at the ask. I would try and fill near the midpoint. Let's take a look at the profile. The reason this is called a swoosh position is because it looks like a Nike swoosh on the simulator. And the idea is I want to be riding on this dotted line. I do not want to let my puts get to expiration. So what I'll do is, on things that have weekly options, I'm looking to roll every week to keep it more than 2 weeks out. And what that does is it keeps the profile looking like this. And it gets cheaper and cheaper to roll those as the stock goes up, because if the stock goes higher, I'm generally looking to roll at the same strike, and eventually if it gets cheap enough, then I'll start rolling up in strikes on the put, or may not even have puts at all. So let's zoom out on this a little bit. Oh, it's already zoomed out to 60%. Okay. So yeah, the other thing about it is when the implied volatility is so high, when the stock makes a huge move, it still doesn't make all that much money. Like it's at 100% gain for the stock, this option combo has only made, it's not even made 200%, and that doesn't account for the roll costs on the put. But the nice thing about it is, going into it like this, I don't need stop losses, and I'm protected on drops. So let's say we get out to next week. March 12th is the next expiration, and the price has dropped. Well, I've got some protection in there. So the other thing about it too, when the implied volatility is so high, is the protection doesn't protect you as much. So if it drops, then I can reset lower, and this actually happened to me with Fisker, and I was able to do a real nice roll on Fisker. I had a swoosh position in Fisker, and I reset that one. Let's talk about Fisker real quick, so I'll basically just do the same thing with Tilray as I did with AFA, so I don't need to go through all that again. Let's look at Fisker though real quick. Do I have a window open for that? Yeah. So it was Friday. I had to roll a put anyway, and so at lunchtime I went in and rolled this one. Where is it at now? 21. Okay, but it bounced intraday. So let's get an intraday chart up for Fisker. Maybe I can just change it here. FSR. Okay. So when I rolled it, the price was around 20. $20 a share. And so I rolled from what I had was out here in August. I had a 25 call, and the put I had was this one, the March 19th, and it was a 24 put actually. So this was the combo I had. Let's add it to quote panel, and I can get a chart up for this. And let's zoom out on this. So you can see, like, it started to run up and it fell back down to, you know, my entry was around 10 on this. It ran up, it fell back down, and then as the market tanked, you know, it started to swoosh back up, right? Because the put protection kicked in. And so when I got out of this trade, I got out pretty much at near break even, and I was able to roll down in strikes. So I don't want to keep holding the 25 call, because the time decay is faster when it's out of the money. So what I ended up doing was rolling into, I rolled this, the price at that time was, let's zoom in, look at 5 minutes. So right around here, the price was 10.5, and here's what I rolled into. I essentially just reset the swoosh position and built it in the way in which I just described. And so I rolled down in strike to an at the money call, which was with the same calendar expiration. So I rolled from a 25 down to a 20. And so you could see that, like, imagine if I didn't have that put. Like, look at the difference. It's, you know, it's a lot cheaper. So I rolled down to a 20, and then the put that I got was an 18 put right here. So I actually got a credit for this, because the combo I had was worth $10, and the one I got into was only price of $6.50. So I got a credit for that, because it's a cheaper combo. Did I build that right? Oh, that's a put. I'm sorry. Call is what I need there. Okay. Yeah, I did get a credit, but it's not as big of a credit as what it was showing. That actually looked wrong. So yeah, I got the 730 call down from a 25 call. So you can see that, like, it's a loss there on the call, but the gain on the put made up for that, and more actually. So I was able to get paid to roll down to a lower strike. So that's nice. What else to talk about? I want to have Chris on later this weekend and see what how he navigated the market on Friday, because it was pretty wild. So anyway, look forward to that if I can get Chris on, and then there's another guest I'm excited to have on. I don't want to reveal the name yet, but hopefully that show can be made this weekend too. I don't know. We'll see. Anyway, thanks for watching. If you like the video, hit like, share it with your friends. This is a new show, so I need your help to get the word out. And thanks for watching. Bye.